So in this last example, I'm going to walk through spoilage in a job costing environment. We went through job costing way back last quad, but we didn't talk about spoilage. So I want to walk through that. It's really pretty straightforward. For this example, the data we're going to use includes the following. We have 46 units that we started, 6 of which are spoiled, and we're assuming initially that that's normal spoilage. The cost for each of those 6 units that have been incurred or assigned thus far is $1,100. And we think we can dispose of them for $235 per unit. So, the defect, we can sell them at a lower price, we can sell them for parts, whatever. So the first thing that we need to do is identify for the spoilage, were these units specifically related to a particular job, and was the spoilage that occurred the result of a particular job, or was it the result of something that is common to all jobs we're working on? Remember, under job costing, we accumulate costs on a job-by-job basis. So the first assumption is that these 6 units were spoiled or defective strictly because of one particular job we're working on. What we're going to do then is we're going to record debit materials inventory for the disposal value. The 6 units at $235. So we'll put those units back in materials inventory at effectively their net realizable value, what we think we can get for them. And then we'll credit that amount out of WIP for that particular job. Now notice what's happening. We're effectively letting this job absorb the cost of the spoilage less what we think we're going to be able to recoup. Now, in contrast, if we believe the spoilage is the result of something that is common to all jobs, then we will still debit materials inventory for what we think we'll be able to recoup. We will credit WIP, however, for the full cost associated with these jobs. So in other words, we're not going to require that this particular job absorb the spoilage if indeed the spoilage is something that's common to all jobs. The difference we're going to debit to manufacturing overhead. So the difference between the cost of the spoiled units and what we think we're going to be able to recoup, we will debit into manufacturing overhead. Remember, manufacturing overhead will then get allocated to all the jobs, and all of the jobs, each job will have to absorb a little bit of this spoilage, which is appropriate if indeed the spoilage results because of something that is applicable to all jobs. Now, in this third example, we're going to assume spoilage is abnormal. Now, what we're going to do is still debit materials inventory for the amount we think we're going to recoup. We're going to credit WIP for the full cost. This is spoilage over and above what we deem acceptable. And then the difference between those two, we will debit to that loss from abnormal spoilage account that will run directly through the income statement. Okay, and that's abnormal spoilage. Now, before we leave this example, I want to go through a couple of other scenarios. One scenario is, what happens if we can rework the spoilage? In other words, we can spend some money, fix the defect, and then actually sell the product. Again, we need to determine, does this relate to a specific job or is it common to all jobs? So in this example, what we're going to assume is that we'll be able to rework those 6 units for $1,800, and effectively they will become good units again. If that is related to a specific job, then we will debit WIP for the $1,800. In other words, the WIP for that particular job will incur an additional $1,800. And then we'll credit cash, materials inventory, whatever it is that we needed to credit in order to, depending on the work that we had to do. In contrast, if this defect and thus the rework is common to all jobs, we'll take the $1,800 and we'll debit it to manufacturing overhead, which will then be allocated to all of the jobs, and each job will get a little piece of it. And then the last example is assuming the rework is abnormal, then that $1,800, similarly to the spoilage cost, will get debited to the loss account and run directly through the income statement. Okay. Again, this isn't that complicated, but we just haven't talked about it. And then the last thing I want to mention is something called scrap. This is where you have material that you're using in your product, but you have scrap. Like, I don't know if any of you sew, but if you cut out material for a pattern and then there are scraps of material left over, sometimes you can use that. Sometimes those are big enough pieces you can use it for something else. Sometimes they're such small pieces you end up just tossing them. So what we do with that depends on several factors. So we're going to assume that we had scrap that amounted to $700, materials that we could not use after the production process. First example is that we recognize the scrap at the time of sale and it's not material. The time of, so in other words, we don't do anything with that $700 until or unless we actually sell it. Then what we would do is we would debit cash for $700 at the time of sale and credit scrap revenue, running it through the income statement. It's immaterial, it's not going to make a huge difference, so let's just hit revenue with it. The second example is that it is material and related to a specific job. Now what we're going to do is we're going to debit cash for $700 and we're going to credit WIP for $700. Again, we'll do this at the time of sale, but we're not going to run it through revenue because it could distort our revenue. We'll credit WIP, thereby reducing the cost of this specific job for the amount that we get back on the scrap. The third example is that the scrap is material, but it is not related specifically to one job. It is common to several. Then you might detect a pattern here at the time of sale. We will debit cash for $700 and then we will credit manufacturing overhead, thereby reducing the manufacturing overhead that's being allocated to all the jobs. So each job will get some impact from that. Those three examples are where we account for the scrap at the time the scrap is sold. Now, we can, if it is significantly material, we can recognize the scrap as inventory, in which case we would take the disposal value of it, debit materials inventory, and credit WIP at the time we have the scrap. And then we debit, when it's sold, we'll debit cash and credit materials inventory. So that we're leaving it in inventory until such time as we actually sell it. And we're hitting WIP or reducing WIP at the time of that the scrap is identified, as opposed to in the scenario up here where we waited and did not make this entry until it was actually sold. Those are management decisions as to what's material, what's immaterial, and how management wants to handle it.